And, it's really somewhat tone deaf for world or international entities to tell countries like India and Africa, hey, you need to build out your renewable energy infrastructure. It's like those countries today, a lot of them don't even have power in big parts of their countries. It's interesting. Here's just one anecdote on that. But a year ago, there was a United Nations meeting on, hey, we need to really be encouraging renewable energy development in the emerging market economies. And the question was posed to Nigeria, when are you going to start focusing on building out your renewable energy infrastructure? The Nigerian representative said, see, the problem with you guys right now is you're worried about what's going to happen to climate in 100 years. I'm worried about what's going to happen to my people over the next 100 days.
Hey guys, welcome back to the Fort Podcast. My name is Chris Powers, and I want to thank you for joining me today. This show is an open-ended discussion and journey covering real estate, business, entrepreneurship, and investing. I would love to hear from you by tweeting me at Fort Worth Chris on Twitter. And if you've enjoyed this show, I would be super grateful if you would follow us on Apple Podcasts, Spotify, or whatever platform you listen to. And if on Apple, it would mean a lot if you'd leave a rating and review. Last but not least, you can find all these episodes on YouTube. Thank you so much again for joining me, and enjoy the show. So today's a special day for me. Conrad is one of my dearest friends in the world. We went to school together. And if there's somebody that probably shared the same work ethic that I think I have, it's Conrad. We went different directions. Conrad got into the energy industry. I got into real estate. But Conrad's one of the smartest people I know on the topic of energy and oil and gas. And so today's going to be awesome. Conrad, thanks for joining me.
Thanks for having me, Chris. Looking forward to this one.
All right, let's just kind of set the stage. You got into energy investment banking right out of school, and God bless you, you're still in it. How have things, maybe just kind of paint a picture for what the industry looked like when you started 12 years ago, and maybe what it looks like today with oil back at $111 a barrel as of this morning?
Great question. So a lot's changed when we got out of school in 2009. Since then, I'll just maybe start there. So in 2009, a big part of energy or oil and gas investment banking when I came here was very different than today. I mean, for one, we actually had bankers dedicated to coal. That was another niche of focus at that time that is no longer really relevant. There was a much greater focus on kind of Gulf of Mexico and conventional type assets. Shale and the unconventional plays were all still, essentially in their infancy. So that evolved quickly since then. But in 2009, 2010, 2011, a lot of those plays were still very early days. And when I look at what deal flow was back then versus today, there was a lot of excitement in shale. There's a lot of excitement without a lot of data. And so I recall, us bringing in international joint venture partners to some of the domestic operators and selling really large, shale acreage positions with very little data. We'd have an example of this would be Chesapeake's Marcellus or Appalachian business. This was an asset that covered the whole state of Pennsylvania, from northeast Pennsylvania down to West Virginia and Ohio. And we had one type curve in that model that was presented. And today it'd just be very different. Today we're encumbered by data. There's tons of wells. It's a much more of a manufacturing process. And it's no longer the nascent growth industry in terms of shale as it was a decade ago. So very different strategic interests, very different consolidators and players in the space. And, Gulf of Mexico and some of the conventional stuff that was, a bigger part of the business a decade ago is actually increasingly, I think becoming more relevant again today as shale further matures.
Why is it becoming more relevant today?
I think there's a lot of the public guys have become more agnostic to being, hey, I have to be in this basin, I have to be in that basin. It's becoming more of a traditional public company cash flowing business model where free cash flow yields are in focus, distribution or dividend profiles are in focus. And there was this period of time for the last 7-8 years, probably prior to 2020, where the public markets really, were seeking, hey, I've got to have a pure play Permian guy. I've got to have a pure play Marcellus guy. And I think the market's more agnostic to that today. And there's probably more appreciation for a more diversified asset base than there was for much of the last decade. So you're seeing guys that used to be pure plays in one basin look at other basins. Guys that might have only been oil focused are now looking at some gas deals and vice versa. And it's more of an acquire and exploit model, I think, across the whole industry, as opposed to a shale growth model that was really in vogue for the last several years.
I'm not trying to ask a loaded question, but like when was the inflection point that we started having enough data to start going, the Permian Basin's great, but it's maybe not all great. Like, here's where the actual oil is. Like, when did we start getting enough data on how fracking worked and the cost of, pulling oil out of the ground and where it was best and where it was worse? Like, when did the inflection point come to where it kind of changed from that 2009-10 where there wasn't not a lot of data, everybody was kind of wildcatting and figuring it out again?
Yeah, I'd say in parts of the play, guys are still cracking the code. It's not 100%, delineated in the Midland and the Delaware basins, but I'd say the core parts of each basin are certainly delineated at this point. And there's still not uniform acceptance of one, right development pattern versus another, one right frac design versus another, one right set of targets to develop in that pad program. So there's still, debate amongst operators, even what the best way to drill undeveloped tracts in the core of each basin. But I would say the band of differences has shrunk and continues to shrink with each year.
When did like oil and gas start becoming call it a tough word? When you got started, again, there was a lot of excitement. We've been through this period, call it over the last 5 or 6 years, where, capital's starting to flee. When did that kind of start? And then I want to get back to where we are today at 111, where, we need some production and we need it quick, but there's this whole narrative that oil and gas is bad for the world, and you've kind of been at the center of it. So I want to get into talking about kind of capital flows.
Yeah, very, very good question. So clearly there's been capital flight out of the space. You can really see that when you look at the share price performance over the last several years, and a lot of the energy focused investors' performance, which a lot of that's publicly available. If you look at pension disclosures and endowment disclosures on their returns, they'll disclose, hey, here's how this investment and this fund did versus that fund. The returns in the sector were abysmal for the better part of the last decade. And I'd say a lot of that was growing pains. Guys figuring out the right way to develop their assets. A lot of that was the industry being a victim of its own success. We went from a period of, when we were in school, oil and gas were commodities that were scarce, and there was a finite amount known in the world of, hey, there's this much available. And then unconventional plays, rapidly changed a lot of that. And we went from, a world of those commodities being scarce to a world of who's the lowest cost producer. And so that changed a lot of the return assumptions that guys embedded in what they were underwriting. Guys were underwriting, prices at $90 in 2014 that ended up being $50 for the next 5 years, right? Same for gas. Guys were underwriting $5 per MMBTU gas decks, $4 per MMBTU gas decks, and they were realizing $2.50 or $3 over the next 5-year period. So, price has a way of making guys look smart or dumb, depending on what happens there. And I think poor returns is first and foremost the reason for the capital flight, but obviously the energy transition has been a big part of it too. I think that's been more of a convenient excuse than a real reason for inadequate capital availability. Because you look at there's plenty of capitalists out there that'll say, hey, if I have a good return, this is a very relevant sector and it's not going anywhere for a long time, I will invest in this. If you have poor returns, though, it becomes a lot easier to kind of tie the green narrative into what you're saying and make it less of a focus. But going back to the original question, when did I start seeing that capital flight? I really started seeing it in late 2018, 2019. I was on a road show for a SPAC, and we were out trying to raise a pipe to get a deal done. And we had a great lineup of meetings, but there's just a lot of guys that have been burned in the space. You have 100 meetings with investors, and you start to notice when 70 or 80 of those meetings are guys saying, "Wow, I've just lost so much money." And at that point, you're trying to build a book around the last 15 or 20 names that haven't told you no, and that's tough. And so I think that the current price environment could start to change that. I frankly get worried when we see this much volatility, when prices move this fast. That has a way in oil and gas of being a precursor to a sharp drop in prices. I do think that this time is a little different, though. And by what I mean there is that the excess deliverability of OPEC, of the global producers, is at a historically low percentage point relative to global demand. And quite simply, the global industry has not invested enough capital, due in large part to a lot of this capital flight, and due in large part to a lot of the international state oil companies or IOCs, increasingly allocating capital to renewables and transition efforts. That is going to exacerbate this supply and demand issue we're seeing today. And then you put on top of that, you take out the second largest exporter in the world for oil exports, Russia, with the ongoing conflict, and you could really have a near-term price spike that I don't know where the ceiling is.
Like north of 200, or you really don't know where the ceiling is?
I really don't know where the ceiling is, because the demand is fairly inelastic. It's different than most supply demand curves you look at. You say, hey, move up the price twofold, and guys are going to use half as much of it, or maybe 60% as much of that product. Oil's different. Gas is different. It's much more inelastic. You can double the price, and guys will sacrifice other parts of their consumption budgets and still fill up their tanks. So it is a price does impact the marginal demand, but the marginal demand is a fairly small part of the pie.
Can you speak to how undercapitalized we are? Like, where maybe should we be and where are we?
Absolutely. So over the last decade, global upstream capex has averaged, depending on what source you look at, somewhere between 600 and 700 billion a year. Global upstream capex. That's exploring and developing new fields, new production, new reserves. That number for the last 2-3 years has really been closer to half that, 300 to 350 billion. So you look at, I talked about how in 2018, 2019, you really started to kind of feel the capital flight. And if you look at just kind of global upstream oil and gas capex, that number in 2020 was just over 300 billion. In 2019, it was something similar. So that's really where you've seen global E&P capex fall off a cliff. And the difference is not played itself out in full yet, right? I mean, we've had Guyana, which was a major discovery by Exxon Hess. And outside of that, in the last 5 years, there hasn't been many major global discoveries. The U.S. can grow production a little bit from 12 million a day. Where we're at right now, we can get up to 13, 14, maybe. But you really need institutional investors to tell public operators, go increase rate. And they're not telling them that right now. Right now, they're saying, increase my dividend, increase my buyback. And the publics are maintaining really strong capital discipline. They're really adhering to that, which is different. That just wasn't the case in the last boom cycles. When prices would go up, guys would increase rig count, and free cash flow would essentially be the same as in bad years, right? This cycle is different. Guys are saying, hey, I want to maximize free cash flow. And this excess oil price dollar is going to my investor. It's not going to my drill bit. So
is that good for the consumer?
It's good for the investor. I think that the consumer is about to be in a world of much higher energy prices, both oil, gas, in all forms. And Europe's at the front end of this. I mean, so Europe has tied a lot of their energy security with natural gas to Russia. And even before this Ukrainian conflict, I mean, this last winter, you saw natural gas prices in Europe reach $40 per MMBTU. You put that on an oil equivalent basis, that's $240 a barrel. That's to heat their homes. That's expensive, right? And I mean, you ask, where's the cap on oil prices? I'm not sure. And I think that the macro intermediate picture for where supply is going to be is really challenging. I mean, we talk with the majors all the time. The cupboard of exploration projects and big new fields coming online is very low. It's very light. And you just ask yourself, where's the new million barrels a day the world needs to facilitate supply growth coming from? I don't know.
When you talked about, I can't remember what you said. It was the Ghana field or something like that. And you said that's the only major discovery we really had in the last 5 years. Can you put into context for someone that doesn't know exactly how oil and gas works? Like, how big of a discovery actually was it? Was it that big, or it was just big because it was bigger than everything else?
It's big. I mean, it's going to be 500,000-600,000 barrels a day. The world demands 100 million barrels a day. So that's, 0.5%, give or take, of global demand and supply.
Just to set the context, when we talk about 100 million barrels a day, a lot of people in America think about, how does America use oil and gas? And, we need to move to electric. But can you speak at all? Like, when we talk, we always talk about this. There's all these other places in the world. Americans tend to forget that there's places like Africa and, lots of these kind of developing countries and continents that they haven't even gotten onto fossil fuels yet. Like, how much of the world is just now starting to come onto fossil fuels, and how much of the world is actually eating up that 100 million barrels?
It's a great question. So you're right. It's really somewhat tone deaf for, world or international entities to tell countries like India and Africa, hey, you need to build out your renewable energy infrastructure. It's like those countries today, a lot of them don't even have power in big parts of their countries. And it's interesting. Here's just one anecdote on that, but at the one of the, I think a year ago, there was a United Nations meeting on, hey, we need to really be encouraging renewable energy development in the emerging market economies. And the question was posed to Nigeria, when are you going to start focusing on building out your renewable energy infrastructure? And that the Nigerian representative said, see, the problem with you guys right now is you're worried about what's going to happen to climate in 100 years. I'm worried about what's going to happen to my people over the next 100 days. And there's a real disconnect in terms of, attendees to the Paris Climate Accord, and then where a lot of the emerging market economies are today that lack basic necessities we all take for granted. So that's a long-winded way of saying, I think there's going to be continued growth of traditional fossil fuel demand in a lot of those emerging market economies for a long period of time. And to assume that that's not the case, that they can skip a step and build out renewable energy grids and power sources is somewhat unrealistic.
Yeah. You don't have to say it, I will, but it sounds like the first world countries do a good job virtue signaling to the world, while there's still a lot of the world that lives in reality. And like you said, they're still not even on a power grid. I mean, they're hoping for clean water on a consistent basis. And we're sitting here in America thinking everybody should drive a Tesla. Again, you don't have to say it, I will, but it's just kind of interesting how little the world thinks about the globe when it comes to energy. Oil's at $111 a barrel. You're a banker, so you're seeing transactions left and right. Let's just talk a little bit about what are you seeing? I kind of want to talk about it in two ways, M&A wise. And right now with energy, like you said, is at 111. It's probably going much higher before it goes lower. It would seem, if as a finance guy, there's a lot of good deals to be done right now. So let's just start with kind of M&A activity, and we can talk about midstream, upstream, whatever you want. What have you started to see since we hit negative $30 a barrel last year to where we are today?
It's a great question. I think deal flow certainly picked up in the last, Q2 through Q4 of 21, and continues to be very active in upstream in particular. In midstream, there's been some activity, albeit not as active as upstream. I think the market we've been in has been very supportive of consolidation. That's a clear theme from institutional investors. They want less public companies that are bigger and have more scale and more ability to, optimize capital allocation and everything else. So there's a clear mandate from the investor base saying, consolidate, do deals that are accretive to where you trade, and reduce your cost structure. And M&A is a great way to achieve those objectives. So M&A market has been very busy the last year. I will say this recent move up, and anytime there's a move up or down this fast, I start to get nervous and what the impact that'll have on deal flow. I mean, naturally, sellers are going to want guys to value their assets using $110 oil decks. And then, they're, especially with the backwardation we have in the curve right now, which is so every commodity has a futures curve where you can buy oil or sell oil at a certain future date for delivery. And if you look at kind of spot oil prices, yes, they're at 115 a barrel today. But if you look at 12 months out, that number is, $95. And if you look 24 months out, that number is $80. And if you look 48 months out, that number's $70. So from spot month of 115 to 4 years out with oil close to $70, that's some very significant backwardation in the curve. And that's how guys typically underwrite acquisitions or M&A in oil and gas. They'll use strip pricing, which is the futures curve. And that's a historically high level of backwardation. And you can make I think the logical question of that is, why is the curve so backwardated? And the reality is today it's a seller's over market. You've got a lot of natural hedgers, so E&P companies that like to hedge out, and there's very little demand on the buy side to buy futures contracts and push prices up in the out years. That's essentially limited to speculators, because a lot of the airlines aren't doing that, refiners aren't doing that, and you've got a fairly financial market, and that's very speculative in the back end with very low liquidity. So we've got really high backwardation. That's not good for M&A, and we've got a lot of volatility. That's not good for M&A. That just increases the bid-ask spread between what buyers may be willing to underwrite versus what sellers hope to get.
Is anybody raising funds right now, or is it easy to raise capital? I don't know too much, but hearing things like NGP and NCAP over the last couple of years have had a much more difficult time raising funds than they've ever had. Is that shifting? Are the private markets able to raise capital right now? You saw Larry Fink come out not too long ago and kind of reverse course on his thoughts on ESG and, letting capital flow into oil and gas. Is there positive momentum that capital's coming back into the space? Maybe that's my question.
Great question. Yeah. I think the sentiment around private equity firms being able to raise money is better today than it was a year ago. That's a fact. Are the fund sizes and targets going to be as large as they were 2, 3, 4, 5 years ago? The answer to that is likely no. But several of the largest energy dedicated funds are out raising funds, and I expect some of those to be some fairly big numbers. I'd say the biggest change in kind of capital flows has probably been the source of the capital flows. Historically, endowments played a very meaningful role in a lot of private equity funds. Most endowments have likely permanently fled the space. There may be some that come back, but endowment capital is certainly more challenging to raise in oil and gas. There's just an immense amount of social pressure in a lot of those institutions today against fossil fuels that didn't exist historically. So that's a major source of capital that's largely exited the space. Pensions are still very active investing in oil and gas funds, and I'd expect that to continue. There'll be certain state pensions in certain areas that may have more social pressure than others. But you look at CalPERS and CalSTRS, the two biggest funds or two biggest pensions in California, and they're both very large oil and gas investors. So will that hold? That's TBD. And then you look at the other large source of private equity fund dollars, and that's really sovereign wealth funds. And I think what you're seeing from all the private capital sources, endowments, pensions, sovereign wealth funds, family offices, foundations, they're still investing, but they're investing in less funds, and they want more flexibility in how they invest. And I think the private equity firms are tailoring their fundraising efforts in ways to appeal to their largest investors. There's a fund out there today that's raising capital that's going to effectively have silos where LPs can participate at their desired level in different silos.
What would those silos be?
There'll be an upstream silo, a midstream silo, an energy transition silo, and they'll basically say, look, if you don't want to invest in upstream, here's energy infrastructure / midstream, and here's my transition silo. And they can still commit to those two. Or if someone is open to still investing in upstream and doesn't want or buy into the transition, investing thesis, they can invest in just that, or they can invest in all three. But you're seeing funds give LPs more flexibility in how they invest in the space, because the one size fits all, hey, I'm going to go raise, $5 billion fund and, kind of blind pool where that goes is less desired by LPs today. There's a less uniform interest in how guys want their capital invested.
And is it fair to say that the ESG kind of viewpoint on this is fossil fuels are bad because of climate change? Is there any other, besides climate change, is there any other reason that ESG is kind of pulled back the folks that are interested in this industry?
I think that's the largest culprit, right? It's just, hey, I want to, invest in a way that adheres to the Paris Climate Accord. I want to achieve, net zero on carbon emissions.
Mm-hmm.
So that's the biggest driver of some of the disinterest in fossil fuels from ESG-minded investors.
Can you speak at all to kind of labor and employment, maybe both on the upstream, midstream, but really what you're seeing in oilfield services? Have a lot of people left the industry? Where are all these people? What does it look like right now if you're trying to hire people in oil and gas, no matter what sector you're in?
I'd say, I'll just start with our group, because as a specific anecdote, the Jefferies Energy Investment Banking Group has never been larger. We've got 112 people in our group. I think most energy-focused investment banks are certainly looking to grow in this market. I think upstream companies are hiring opportunistically, but everyone is probably more acutely focused on G&A and cost structure than they were in past cycles. The service industry side is certainly in a hiring mode right now, playing catch up. And we're seeing cost inflation across the board. When oil prices go up, people don't always get this point, but the correlation between kind of service costs and oil prices is very, very high. And so when prices go down, a lot of people get fired. A lot of crews have a lack of contracts, and so they'll do things for cheaper. And the inverse is true when prices go up. So the returns to the producer are less elastic than you'd think, given CapEx is a lot lower when prices are down. CapEx is a lot higher to drill the same well when prices are up. And certainly the service side right now is hiring.
I want to circle back to one thing you said a second ago when we were talking about the delta between kind of CapEx needed for upstream versus what we're currently getting. I mean, there could be like a $300 to $400 billion delta. Maybe that's shrunk a little bit. But somebody might say, well, yeah, there's less money going into oil and gas, but we've put all this money into solar, so we're getting energy in other places. So maybe the question is, like, because we have that delta of $300 to $400 billion, that money's obviously been going other places. Has the other places kind of made up for the lack of oil and gas, or like, how do you think about that? I don't know if I'm asking it the right way, but that money had to go somewhere.
No, it's a really good question. I mean, ESG and renewable investment has been immense, and it needs to be. for the next several decades. Despite being an oil and gas guy, I'm not opposed or against renewable energy. I think all forms of energy are going to be needed to meet global population growth. These emerging market economies, improving their lifestyles, and that capital is productive. It's at, granted, a much lower return, and we hear it directly from a lot of the majors and state companies we work with that invest in renewable projects, and we also have an ESG arm in our group as well. I mean, the return thresholds in that space are just much lower. And, one anecdote from a major state oil company is, look, we'll invest in those types of projects, even if it's low single digit type returns, because we have to. And that's what, our stakeholders require from us today. There's been some public companies that have done that more forcefully than others, largely majors. And I think investor reception to that is still mixed. You could make the case that it's been poor, because some of the guys that have done that the most have actually traded at depressed valuations. So, yes, that capital is productive. It's not directly replacing the demands for oil, though. I mean, the reality is, and not a lot of people appreciate this, you could take every internal combustion engine car off the road in the world, and oil demand would be in a similar place as it is today in 40 years, just off other demand sources of oil. So, that's something a lot of people don't appreciate. Of the 100 million barrels a day the world demands for oil, only about 35 million barrels of that is for cars, for consumer mobility. Much of the rest of the demand is jet fuel. It's asphalt. It's petrochemicals. It's other derivatives. It's ships, cargoes. So there's a number of sources of demand, and cars and consumer driving is just one of the sources to the pie. But at a macro level, we've certainly underinvested the last several years, and I think any long-term demand forecast you look at for oil, even the most bearish forecasts, still project somewhere between 90 and 100 million barrels a day of demand in 50 years. The commodity is not going anywhere. And anyone that thinks we'll be off oil in 10, 20, 30 years has not studied the data.
Is there any bear case in the short term other than capital shows back up? We drill a ton of oil, supplies pick back up. Obviously a global recession or anything could slow demand down a little bit. But if somebody said to you right now, like, what's the bear case for the price of oil, not the economy, but what is the bear case for the price of oil over the next 5 years? What would you say?
That's a hard one because I'm such a bull, and I don't normally take a stance on price, but it's hard not to be a bull right now. I think the bear case, if you were to have one, would be, there's some breakthrough disruptive technologies that emerge that aren't known today, right? Like, could there be, battery technology that's developed for airplanes? Could there be replacements at a large scale for plastics, that doesn't require oil? Could there be, ESG type asphalt technology that breaks through that doesn't require fossil fuels? Could there be, larger scale adoption of EVs than what's currently expected? Today, EVs are still a very small part of the market. I think even at the end of the decade, they're still expected to be a sub 10% part of the market. In 2030, could EVs become 50, 60% of the market? Sure, they could. that would be bearish for oil. So I think the short answer, though, is I think you really need kind of some breakthrough technologies or breakthrough adoption on EVs that just isn't anticipated at the present.
Just to expand on that, from your point of view, are there any interesting technologies that have, come through the bank or that you're seeing, or companies that are transacting where they're maybe, like, I think if you think of oil and gas, the last big technology breakthrough, maybe I'm wrong on this, was kind of fracking. And this isn't necessarily even an oil and gas question, but is there anything out there that's exciting that could put a dent in oil usage?
I think probably in that camp, one of the most exciting things being tested right now is probably alternatives to lithium ion batteries, because that's the biggest problem with renewable energy, really. At the end of the day, I mean, one, it's intermittent. It's only available when the wind's blowing or the sun's shining. And so it's an intermittent power source that effectively requires utility scale or very large scale storage for it to have practical use in the grid. And that's something that a lot of people don't appreciate. Power storage is something that's still very challenging to do at any real scale. And there's some emerging tests and alternatives to lithium ion batteries that could allow for much more significant storage of power. And that, to me, would be a pretty big game changer. I mean, the biggest batteries in the world today can only hold minutes or seconds of power demand in their regional areas. If you had an alternative to lithium ion batteries that allowed you to hold days or weeks of power at a large scale, that would be disruptive. That would make the ability to supply EV demand at a large scale much more actionable.
Okay, on Russia and Ukraine for a second, do you have any data on, like, by the what we're living through right now, what that conflict is doing to the world, albeit how much energy is being withheld right now, or how is that situation actually impacting the world, like, today?
In terms of oil markets, or in terms of just in general?
Just in general, from an energy perspective. Obviously it's, there's a lot of people that depend on that energy. I'm sure a lot of the majors have, fields in Russia, and now they're having to maybe take a stance. But, like, is there anything interesting that you're seeing that's like, because this has happened, this is what's going to happen in the market? And maybe if you have any forward-looking thoughts on how this extrapolates, even if the war ended, as we're speaking.
Yeah, I mean, I think what you've seen is a lot of the majors and international producers that have holdings in Russia, they've said, look, we're going to stop all further investment, and we're going to seek to divest those as quickly as we can. I mean, it's obviously going to be a buyer's market for those assets, because there's not going to be a lot of risk appetite to say, hey, I'll go buy shares or interest in Russian oil production. But I think I wouldn't be surprised if there's some hedge funds out there that look at those investments as, hey, this could really turn around if Russia, if there's a ceasefire and relations with them normalize in the international community. So I think, your first question, though, would be, I think the biggest near-term catalyst you could see as it relates to Russia and the oil markets would be if the U.S. administration puts a ban on oil exports from Russia. That's already effectively happening without them putting a real ban on it, because there's no ships that are willing to pick up Russian oil right now. So that's why you're seeing this rapid rise in oil prices. at the front end is because guys are effectively, pricing the market without Russian oil exports today. But you put the official export ban in place, and I think there'd be a further spike in prices.
How big is Russia in relation to like the oil market? How much does the world actually depend on them? Any kind of key data points that come to top of mind when you think of how important Russia is in this whole puzzle?
Very important. I mean, very, very important. I mean, the three biggest oil producers, and really the big three, everyone else after these first three is much less relevant, but it's Saudi Arabia, Russia, and the U.S. And they each make, give or take, 12 million barrels a day right now. So that's 36 million barrels a day. That's, more than a third of total world oil production. And so you look at who are the biggest exporters. The U.S. exports very little. Saudi Arabia is the biggest because their domestic demand is much smaller than what they've produced. But Russia is the second biggest exporter in the world. So they have, somewhere, give or take, around 8 million barrels a day that's exported globally. You take those 8 million barrels a day out of the global market because no one wants to buy them or because they're sanctioned, and that is going to have a very dramatic effect on the price of oil.
Who is the largest consumer of oil? Is it the United States or is it China or India or neither of them?
Today, the U.S. is still the largest consumer of oil. The U.S. is not the largest consumer of energy. That would be China, but China is expected to eclipse U.S. oil demand here in the coming years.
Can we talk about nuclear for a second, if you have anything to say on it?
Sure.
It seems to be a widely adopted, almost bipartisan, maybe not bipartisan, but just from reading Twitter and a lot of things, it seems like it's something that a lot of people from both sides of the aisle are kind of agreeing on is this really clean source of energy. We've come a long way. Maybe we understand it better. It's not as risky. Are you seeing any developments in nuclear that could be interesting for the world, or is it still kind of under the rug?
Yeah, I think nuclear is, you could argue nuclear and natural gas are really the two keys to reducing carbon emissions globally. Now, whether nuclear will be increasingly adopted or used is a totally different question. A lot of countries, there's real political pressure not to not rely on nuclear power. France probably has the most nuclear power as a percent of their power supply of any country in the world. And it's a very, very clean source of power. It's, Bill Gates has a book on nuclear power. He has a documentary too. He's firmly of the camp that it's the key to reducing carbon emissions globally. It's clean, it's predictable, it's a base load, so it's not intermittent, and it's a very good use of power. But it's been troubled by historical events that have created a lot of political sensitivity around nuclear power. Chernobyl power plant explosion in Ukraine's the best example of that. I mean, that was the worst nuclear disaster, nuclear power disaster of all time. So there's certainly a lot of political sensitivity around nuclear power. There's been a lot of investment in trying to build mini nuclear reactors and power plants. I think that's a promising front. And I'm in the camp of we need all forms of energy to meet global power demand, and nuclear should absolutely be a big part of that puzzle.
And is it fair to say the reason why nuclear is not moving at the speed it should is because people still remember Chernobyl and Ukraine? It's like the disaster that occurred from that is what stopped it, or what are the other reasons why something that seems pretty logical is not getting done at scale?
It's not isolated just to that. This happened in Japan as well. This is something that there's a number of bad nuclear power events over the course of its history. So, safety in that power source has got a mixed track record. But I think technology and safety today is much better. There's just a public opinion kind of reluctance to rely on it. I think, there's real pressure in New York right now, for instance, to decommission their nuclear power plant that's 30 miles north of Manhattan. I mean, I think a lot of people say, I don't want to be near it. And so you then get forced into, well, where can I geographically put this? And it's still a bit of a political football in the court of public opinion.
I want to bring it back to oil and gas, and then we'll get down to the last few questions. But are there any basins that are coming back online that have been asleep in America for the last, call it 4 or 5 years? Or basins that have been sleepier than others? Is every basin kind of rocking and rolling right now, or are we kind of still sticking to the Permian and a few of the ones that are a little more predictable?
The Permian is the one that matters the most, and that's where the large amount of strategic interest and demand is. It's also generally the lowest cost oil focused basin in the U.S. So it's very much the center of gravity and the domestic oil and gas markets. On the gas side, Marcellus and the Haynesville are really the 2 points of activity and focus. The Marcellus is somewhat plagued by egress issues. It's hard to get gas out of the basin. So growth in that basin is somewhat limited and governed by the existing FERC-regulated pipes that can get gas out of the state. And the current administration and state pressures around new export pipes out of the state are really tough. So that's not likely to change in Appalachia. Haynesville is near the Gulf Coast demand centers. It has much more growth potential relative to Appalachia, and so you've seen a lot of M&A activity in the Haynesville in the last 18 months. A lot of the large private producers there have recently been consolidated, and you look at the other major plays in the U.S. The Bakken certainly is more mature. There's just less runway. It's very developed at this point. I don't have the exact stats in front of me, but if you said there was a set percentage of how much of the economic sticks have been developed, you'd probably say 60-70% of the economic sticks in the Bakken have been developed today. So there is some runway, but it's just limited. And then you look at the Eagle Ford, it's the same. So I think this all points again to more of the bull case for oil, which is, there's a finite amount of economic inventory left in the Bakken, the finite amount of economic inventory left in the Eagle Ford, and the Permian is very vast. There's more stacked targets there than anywhere else in the U.S. But much of the core in the two plays is rapidly getting developed. If you go operator by operator and you kind of say, hey, what's their core inventory life? It's been extended a little bit because in this world of capital discipline, guys are running less rigs. And that's kind of, had the effect of increasing their inventory lives. But, we've built out, DSU, that's a drilling unit by drilling unit type model for the whole Permian. And if you look at the core of the Midland and the Delaware, there's probably less than 10 years left of core inventory left.
Can you define real quick what core means to you?
Core to me means locations that can be developed at $50 oil and you make a 20+% type return.
Got it. Okay. Sorry, I interrupted you.
No, I mean, it's a subjective point. It's not black and white, and guys will have different answers to that. But the highly economic cores of the Midland and the Delaware Basin have less than 10 years of inventory left. So we're not talking about decades of really economic stuff, which just tells you, guys are going to have to move to the fringes of those plays. Guys are going to have to look at extending the development fairways of other plays. And what's that all call for? That all calls for higher oil prices.
How much, and back to like kind of tying it into technology for a second, but when somebody develops an oil and gas well, they're not pulling 100% of the oil out of the ground. Aren't they only pulling like 15 to 20% of the oil, and then pressure drops so you can't get the other 80% off? Or is that wrong?
No, that's exactly right. You've got geologic maps that say here's the original oil in place, OOIP, and then you've got your recovery factor, which is what is your type curve? What is your well going to ultimately produce over its 50-year life, relative to what's in the ground? And that ranges play by play, target by target, area by area, and is somewhat influenced by completion design and everything else that goes into developing an asset. But those recovery factors in the primary development phase, which is drilling a well and producing it, range from anywhere from 10 to 35%, depending on what play you're talking about. There's a secondary phase of development that occurs in a lot of plays, though, where guys will re-inject those wells with CO2, or that's why in the 90s and 2000s there's a lot of CO2 floods, a lot of water floods. Those are called secondary production phases, where guys are injecting things to build up reservoir pressure or pull incremental reserves out of the ground. So in those types of assets, the recovery factor will go up, as they produce further. But in general, you're right. There's going to be a lot of unproduced reserves that are in the ground that technology over time could make more economic, or prices over time could make more economic to produce.
Yeah. So that could be, put that on the technology list of things to be created. That would have a huge impact if you could find a way to get another 20% out of the ground.
Absolutely.
It wouldn't be an energy podcast if we didn't talk about crypto in the energy world, both from how it's starting to show up in the oil and gas space, using like flared gas to kind of power this stuff, but then also in kind of the more alternative energy space, the amount of power it's taking to, create this crypto ecosystem. So maybe I'll just start from your seat at Jefferies. Do you guys have any interaction with the crypto world from how energy is impacting it? Not from are you guys buying and trading it, but what are you seeing of how crypto is impacting the energy industry?
It's a good question. I don't have a lot of direct influence from crypto. There's certainly guys out there on the ESG front pitching it as a good solution to flared gas. And that actually kind of goes into one of the questions you asked earlier around what are other initiatives ESG-minded investors are focused on. Certainly a big focus of that community is reducing flared gas, and in particular reducing vented gas, because gas is methane, and methane has 40x the greenhouse gas heat storage ability as carbon. So methane is a very potent greenhouse gas relative to carbon dioxide. And so guys using flared or vented gas as a power source, as opposed to emitting it to the atmosphere to power these hashing computers that mine Bitcoin, it's a good economic solution and ESG solution for guys to mine crypto with a effectively free power source.
All right. I thought I would end it on maybe a fun note. This has been awesome as always, but you got to enter the industry and work with one of the maybe most iconic oil and gas people that really revolutionized shale. You got to work with Aubrey quite a bit. Can you maybe just speak to like what you learned from him and what working with him was like, and why he's missed by a lot of people?
Man, I miss that guy, and I think about him a lot. He was the most charismatic leader I've ever worked with. He was such a visionary, and he was such a people person. And even from a really early age in my junior part of my career, he was just went out of his way to let me know how much he appreciated, the hard work we were doing for him at the time. But he was someone who woke up every day and had a to-do list, and he would go through it, and he'd have an idea Monday, and there would be a signed PSA, Friday. He had a risk tolerance that was unique. He had
That's a good way to put it.
He had a personality that was, just you wanted to be around him. You wanted to hear what he was going to say or do next. So I miss working with him all the time, and I could tell you a number of different stories about his character, but no, he was a phenomenal leader and deeply missed.
Did he sleep?
He did sleep, but he'd wake up really early. And, I was in his office in Oklahoma City a couple times, and he had a recycling bin next to his desk. And every day his admin would bring in different reports, and he would just, throughout the day, he'd throw the reports in the recycling bin. He'd take the recycling bin home with him. He'd come back the next day having read it all, and then he'd just wake up, sending a million emails in the morning with an empty recycling bin, and rinse and repeat. Go start it again.
I love it. All right, man. This was awesome. I'm lucky that I get to hear it from you one-on-one off the podcast, but we nailed it. Energy's, it's an interesting world, what we're going through. And I'll just leave it to you, and maybe you have something, maybe you don't. If you were to leave the audience with something to think about, is there anything like kind of on your mind that we haven't covered, or maybe a data point or something that could leave people thinking?
I think if it wasn't already clear, you could probably hear from me through the interview that, fossil fuels aren't going anywhere. Gas in particular should be considered a solution, not a problem. And the long-term carbon objectives of everyone. You look at what the U.S. has done from coal to gas conversion over the last decade, and it's remarkable what it's done to reducing carbon emissions. If that could be applied in China and India and other places where there's a ton of new coal power plants coming on, carbon neutrality is not something that's impossible to achieve. I think fossil fuels will be a part of the long-term energy picture, and guys should not view gas as a dirty commodity. It's a clean commodity that really changed the U.S. picture, and it can change a lot of other countries' pictures rapidly too.
I love it, man. Thank you so much for your time as always, dude. We knocked it out of the park on this one.
Awesome, Chris. Well, appreciate the time, and thanks again.
Hey everyone, it's Chris here again. Thank you so much for joining me on this journey. If you enjoyed the show, please follow the show on Apple, Spotify, or subscribe on YouTube. Thanks again, and I'll see you on the next episode.
Chris Powers is the founder and chairman of Fort Capital LP. All opinions from Chris and guests of the Fort podcast are solely their own and do not reflect the opinions of Fort Capital LP. This podcast is for informational purposes only and should not be relied upon for real estate or investment decisions. The Fort with Chris Powers is produced by Straight Up Podcasts.